Hello there, I hope that you are doing well. Welcome to this new lecture of the 2025 model series. During this lecture I'm going to be discussing the most frequently asked questions which came as a result of students having gone through the model series up until this point. These questions were asked either through the support page or they were asked in my DMs. Now, before we dive into this lecture, I would like to share with you that the majority of questions which were asked were either based around order flow or transitioning from higher time frame to lower time frame analysis and what to look for. So I'm going to be providing to you the answers to these questions. Now, what I've done is I've defined these questions as best as possible to make them as general as possible as well. The first question which we're going to be discussing is how do we determine the order flow when we open our charts? Meaning, how do we determine whether or not we're currently in bullish or bearish order flow? Secondly, we're going to be discussing how we can blend narrative with technicals, meaning how we can blend the overall understanding behind why something should happen with that what the chart is telling to us, whether the price is bullish or bearish. The third question which we're going to be discussing is how can we utilize lower time frame if we established higher time frame IOF. We're going to begin with the first question at first, and that is how do we determine the order flow when we open our charts? When it comes to this question, it's important to note that the order flow gets established by first of all paying attention to, okay, what is the market structure signaling to you from the highest possible time frames? Meaning, what are the highest possible time frames? Think daily, weekly, monthly charts telling to you. Is price right now in a buy program or is price right now in a sell program? Once you have defined what the highest possible time frames are signaling to you in terms of direction, you look into the lower time frames to see whether or not price is confirming that same direction. Meaning, if we are looking at the Nasdaq hourly chart right now, and at the time of this recording, it's the beginning of June and we have been very bullish on the indices, on the American indices futures. If we have established that right there, we're going to be looking for the signs every single week that signal to us, okay, price is likely going to expand towards a specific level, a specific range. This is our drawing query. Once we have established this range, what we can be looking for is we can be looking for buying opportunities heading into that level. Once this drawing query gets met, however, that is when you need to be cautious. So when it comes to the week which you have in front of you right now, this was NFP week. And in this NFP week, what we saw taking place was the following. What we saw taking place was first of all that when we open up right here, we saw the market drop lower for the beginning of the week. This took place throughout the Sunday open and throughout Monday. Notice that we eventually form a low right here and we see the market expand towards the upside. Notice that this low formed at 3 AM, meaning throughout the London session on Monday. We saw the market expand towards the upside and we saw it reach this hourly CB right here on the left side of the curve. I'm going to be extending this CB to the right. Notice that the market rejected this CB at first and we saw the market retrace. Notice that the market repriced lower and notice that it repriced into what? It repriced into the yearly open right here. A new day opens up, the day of Tuesday. And what happens? Open, low. Do you see what I'm paying attention to? I'm paying attention to how we're opening up for the week and for the days. And the reason being is because by paying attention to that open low right there, you're able to establish, hey, we're manipulating lower now for the beginning of the day, whilst we already know that on the higher time frames we're bullish. So what that means is that we're looking for the fact that the lower time frames are confirming to us intraday, yes, we are in fact forming lows of day during London. And because that occurs, you can anticipate what? The New York morning session should expand towards the upside. Why? Because you have a drawing query of the previous week's high right here. The moment that the new week opens up, your eye is immediately drawn to, okay, where's the previous week's high? Where's the previous week's low? Once you have established that the higher time frame order flow is bullish and price shows you that it is in a rush to get somewhere, that is when you can confidently say previous week's high is going to be the level which price is going to be drawn towards. However, what's important to note is that in advance of this previous week's high, what you can see is that we have this RECB right here. This RECB could function as a big hinder on price. And when I say hinder on price, what I mean is that price could reach this range and reject it multiple times. Why? Because if we zoom into this range right here, what I would like to see is that we formed a low right here, we repriced higher, and then we displaced through this low with this CB. Therefore, what we can anticipate is that when price reprices into this range, it is being repriced into an imbalanced price range, and the moment that price leaves this imbalanced price range, this price range becomes balanced, and therefore price is going to try and fight against the balanced price range. And whenever price is trying to fight against the balanced price range, what that looks like is the following: a lot of back and forth going around that range right there. And when you pair this with the week, you can notice that we have NFP week. So throughout NFP week, this is the type of delivery which you anticipate. And when it comes to how we establish our higher time frame order flow the moment that we open our charts, it's important to note is that there's a framework to this, and that's the following. First of all, what you do is you define what is occurring on the highest possible time frames. And when I say highest possible time frames, I'm speaking in terms of, okay, what are the bigger time cycles suggesting? What's the quarterly cycle suggesting? What's the monthly cycle suggesting? What's the weekly cycle suggesting? Once these all tell you a specific story, the next step is then to look at the weekly cycle and begin paying attention to how each individual day is delivering. Because based upon how each individual day is delivering, you can anticipate what the next day is likely going to do. When you pay attention to Monday and Tuesday, what you can see is that Monday expands towards the upside right here. And when you pay attention to Tuesday, you can see that Tuesday also expands towards the upside right here. Notice that I'm anchoring the full day range from low to high. Notice that these ranges are rather large. So what should happen? Well, on Wednesday, we see price reach our point of interest or drawn liquidity. It's the same. Every single A to B turns into a new A to B, as I've been teaching you throughout this model series. So what you can anticipate for Wednesday is a small range day. So when you pay attention to the range which got established on Wednesday, what you can see is that price kept on coming back towards the range of that same CB. So do you see how we're blending, when we come to the charts, time cycles from the bigger time cycles to the smaller time cycles? And when we navigate each new week, we pay attention to, okay, what did the previous day do? Because based upon what the previous day did, we can logically anticipate what the current day is going to do. So what I would like you to start paying attention to is what's happening on any given day, and then see whether or not your weekly objective gets met. When your weekly objective gets met, that is when you should be cautious with holding on to that same idea which you had at the beginning of the week. So if we pay attention to the first question, how do we determine the order flow when we open our charts? What you pay attention to is a variety of things. First of all, you pay attention to whether or not discount arrays or premium arrays are functioning as either support or resistance price. That's a given. Next, that you pay attention to the openings of each new day. If you pay attention to what happens from the midnight open, 12 p.m. New York time, and you pay attention to what the London session does, you can anticipate what the New York morning session is likely going to do. Based upon how the New York morning session delivers, you can anticipate what the afternoon session is likely going to do. So what you're doing is you're taking it one session at a time. And that is a major tip which I want to give to you, where I want you to become more fluid when it comes to finding opportunities. And the reason being is because the model, as I've taught it to you throughout this series, provides a lot of opportunities. And the way that you find your opportunity is by sticking on the hourly chart as long as possible. Now, when it comes to the following question then, how can we blend narrative with technicals? Well, in order to blend narrative with technicals, we must first be able to establish narrative. This is something which I discussed in great detail within the swing trading series, which I released at the beginning of 2025. I really suggest you to go over that even if you're not a swing trader. But in that series, I teach how the masses are getting tricked into false beliefs. And if they are getting tricked into a false belief, whilst the chart is telling you a completely different story, then you know that a high probability trade setup is being set up. And the way that you can internalize this is by looking at the following. What's the reason why everyone would be bearish now And if you recognize the reason why everyone would be bearish now, but the chart is telling to you higher, then you have a very good setup. If you recognize that the masses are bullish, but the chart is bearish to you, then you again have a very good setup. So what you can see is that we're basically going against the masses when the chart tells us to do so. This also, however, means if the chart does not tell us to go against the masses, we simply just keep on looking for long. So let's say that the market is just skyrocketing. It's just running up higher vertically. And the masses are, of course, turning bullish. As long as price has yet to reach its strong liquidity, has yet to reach its point B, we keep on looking for one thing, and that is longs, 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 longs. If price is showing nothing but weakness and it's just dumping and is yet to reach point B or drawing liquidity on the downside, we keep on looking for shorts. Why? Because the technicals are suggesting to us that we should do so. So what you can see is that narrative is this concept which is important when blended with the technicals. The majority of people, they simply look at what the newspapers are saying, they look at what goes around the social media, and they think to themselves that that's the reason why price goes up and down. That's nothing to do with what gets shared on the news. However, the news gets utilized to reprice in a specific way. So our job is anticipating whether or not that news is being utilized for manipulation purposes so that distribution can take place afterwards. A beautiful example of this is right in front of you. And at the time of this recording, there is a lot of chaos in the world. There's a lot of news which is being thrown around. There's a lot of manual intervention taking place. But what happened on Thursday right here was that President Trump and Elon Musk went head-to-head with each other. They used to be friends, so to say, to the public, but they now came out as enemies. They were going against each other. And it happened right here on Thursday. Do you see what happens? Price reprices lower towards the yearly open, towards an old area of inefficiency, which price was yet to trade into, right here, which got established on Tuesday, forms low there, and boom, reprices higher right away. Why or why does that occur? Because technically speaking, IPTA had to reprice into this old inefficiency at one moment in time. If you pay attention to this high, you will see that formed inside of a CB as well. So you know that this is a very important high to monitor. But do you see how the news gets utilized to make sure that that repricing order takes place? Look, whenever you recognize that news is being thrown around the social media or you see it within the news headlines, etc., the moment that you recognize that and the news is telling you something which goes completely against what the chart is telling to you, then you know, man, oh man, this is sweet. Why? Because they're setting up a beautiful setup. Now, the third question is how can we utilize the lower time frames if we have established higher time frame IOF? When it comes to utilizing lower time frames, once we have established higher time frame IOF, the main takeaway which I want you to have is the following. When we have established that the higher time frame direction is, for example, bullish, we will continuously look for longs until our drawing liquidity on the higher time frame analysis has been met. Once this higher time frame analysis has been met, however, this drawing liquidity, that is when we can be looking for opposing scenarios. Why? Because who is making money all throughout that run higher? Buyers. So who is IPTA likely going to target when we see the signs present of a reversal taking place at point B, at our drawing liquidity? It's going to attack those buyers, their stops. That is engineered sell-side liquidity. So a beautiful way that you can internalize this is that the moment that your higher time frame DOL gets met, go to neutral. Don't have any expectation. Price could continue, price could reject, price could consolidate. There are a lot of different scenarios which take place. However, you wait for IPTA to show its hand to you. And when it shows its hand to you and it shows to you, yes, I'm in fact going to reject that point B which you had as your drawing liquidity, and you see all the lower time frame signatures which are in play. So think of time cycle SMT, think of manipulation ahead of that time cycle SMT, think of CSD falling. When you see all these different signatures in play, that is when you can establish, okay, the moment that price indeed begins to roll over and it begins to create premium raise, those premium raises can get utilized to find a shorting opportunity. But here comes the thing. Your focus has to be on swing formations, recognizing whether or not a swing high or swing low is forming. And in the example which we're discussing now, where I'm discussing a hypothetical example with you, I hope that you're able to visualize what I'm outlining to you. If price reaches that drawing quantity which you had on the upside and you see the signs of a swing high formation taking place, the moment that price indeed confirms that swing high formation through SMT and you see CSD taking place, that is when you know price should roll over. And from that moment in time, you can literally use the entry pattern that you prefer to use. And there are a lot of different entry patterns which I've discussed throughout this model series, which you can decide to use. Pick that what suits you best. That's a major piece of advice which I want to give to you. Don't try to be the person that's using all different entry patterns whatsoever. In due time, some of you will be able to get to that level. However, for those of you that are just looking for that first stage of consistency, stick to one. Because if you're constantly changing your entries, it's very hard to find that first stage of consistency if you haven't yet experienced what it feels like to just repeat the same process all the time. Once you have experienced this for a short period of time, I'd say about 3 months, the moment that you have been consistent with purely trading, for example, based upon the market structure pattern or based upon the breaker or whatsoever, yes, from that moment in time, you can say, okay, you know what? What if I enter a bit earlier? What if I enter, for example, as that order block is being established? Or what if I enter if the rejection block is being established? And man, oh man, when you get those type of entries and you pyramid along the way, oh, that's beautiful, right? However, you can only use the lower time frame if we have established what the higher time frame is signaling to you. So as long as price has yet to reach point B, has yet to reach your drawing quantity from the higher time frames, what you do is you look for opportunities in sync with that direction. However, the moment that the drawing quantity gets met, wait for IPTA to show its hand to you. And the moment it shows its hand to you, that is when you know, okay, even though on the higher time frames I'm bullish right now, I can still look for shorting opportunities because IPTA is signaling to me that throughout the current 90-minute cycle, price should expand towards sell side. Because price doesn't go up in a straight line. It doesn't go vertical. It might seem that way, however, there are always retracements. And it's in those retracements that new liquidity will be engineered, which can be made jacked at a later moment in time. So what I would like you to take away from these 3 questions, which I've outlined to you here, is the following. Your focus has to be on one thing, and that is recognizing what is the bigger picture right now. What's the bigger narrative in play? And in order to understand the bigger narrative, we apply exactly the same principles as we do on a smaller time frame, on a smaller time cycle, because that's the only difference. The size and the duration of the time cycle. If I'm paying attention to 30-minute cycles, I'm applying exactly the same logic as I'm discussing to you right now on the hourly chart for the weekly delivery, or when I pay attention to a daily chart for the monthly delivery, or when I pay attention to a weekly chart for the quarterly delivery and the yearly delivery, you name it. It's always the same principles. The only question that you should ask yourself is, okay, what are the arrays signaling to me now? What are the reactions to key previous XH and previous XL signaling to me? Is price finding support inside of a previous XH when we displace through it? Alright, we're going to continue looking for longs. But if price rejects the previous XH, reaches our drawing quantity, reaches our POI, then we can say, hey, price is rejecting the previous XH, we see the signs of SMT taking place, we see CSD, then you know order flow is changing towards the downside. So do you see how it's all fractal? It's all forming in each other. And your job is to find alignment. And you find alignment by making sure that you're aligned with the biggest possible time cycles. And once you have aligned yourself with the biggest possible time cycles, which you will decide on what to use, if you are bullish for the quarter and month, some of you might implement the rule of, okay, I'm only going to be looking for longs. But others might say, hey, I don't really care about such a high direction. All I care about is what's the current session like going to do based on the previous session's delivery. All I care about is, okay, is price right now in the POI? Has it reached a level where I anticipate the reverse to take place from? Alright, I will take a short, even though the quarter is anticipated to be bullish. So what you see is that this has to do with your personality as well. What type of trader do you want to be? Do you want to be a trader that takes 1 or 2 setups a week simply in line with the higher time frame direction? Yes, that's possible. And there are plenty of opportunities like that each month. But some of you are wired a bit differently and you would like to just find opportunities as they're being presented, and you don't care about the higher time frame direction as much, in the sense of you don't care about what the month or quarter is going to do. In my opinion, at first, it's best to simply stick to the higher time frame direction. Find yourself in alignment, and the way you recognize that is that if you're bullish, look for open low. Look for a new day, look for a new session to open low, wait for the signs of reverse taking place, voila. If you're bearish, you wait for open high, into a POI, wait for the signs of reverse taking place, voila, there you go. So what you can see is that it comes back to the same core principles. Higher time frame analysis, dropping into a lower time frame, not immediately 1 minute, but simply a time frame in between 1 minute and, for example, daily. So you pay attention to hourly, pay attention to what's the current day like you're going to do, and then you pay attention to what's happening from these key opening prices. Because based on what's happening from these key opening prices, what we're looking for is looking for manipulation. Because the moment that manipulation takes place, that is when we can anticipate the distribution. And once we see the manipulation ending through the lens of SMT and CSD, that is when we can utilize any specific entry pattern for our entries. And that right there is the main takeaway which I want you to have. Find yourself in alignment with all of the different time cycles. And when you start finding yourself in alignment and you start aligning yourself with that what is being told on the highest possible time frames, and you begin to look at how many opportunities there are every single week, your mouth is going to fall open. And once you have more experience doing that, you can also say, hey, maybe I can look for a counter trend setup simply because I see what the current session is likely going to do. So likely going to run against everyone who's making money. It's going to set up a retracement, or what the current 90-minute or 30-minute cycle is going to do. But that right there requires a lot of experience, and you need to know exactly from what moment in time IPTA is going to spool towards engineered liquidity. And that will come as you start having more experience and you start practicing what I'm outlining to you here more. With that being said, this lecture comes to an end. I hope that you found it insightful. I'm going to be releasing uncensored lectures soon, and that is going to be where I will be applying the model as I'm outlining it to you during this model series. It's important to note is that I will not be giving you any financial advice. Simply because I'll be showing the real-time application of the model doesn't mean that I'm going to say you should trade this way. I will never tell you to go out there and trade. I will never tell you to go out here and use the information as I'm teaching it to you. All I'm telling you is to investigate that, what I'm outlining to you, because I promise you will never be looking at these markets through the same lens again. I want to wish you good luck in your studies and I look forward to speaking to you soon again. Be safe.